All right. Episode 5.
Nice.
And we have Keith back again.
I know, and we are draped in velvet today. Look at us.
We
Look
are.
at that background, gang.
Yeah.
We just look pretty in here.
This is my color, purple.
and all 3 in blue today, too. Like we
Yeah.
coordinated this.
That was we gotta do a better job.
We gotta work on that.
But it's almost like Keith's a staple at this point.
Yeah, it's
Jeez.
I know.
back by popular demand. I want to see the stats.
Yeah.
Whoa. Why am I back
Viewership
here?
through the roof with Keith. Cool. So yeah, Keith is back again. We also had CPI this morning.
Yeah.
It was, I think, better than feared, if you will.
Yeah. Yeah.
I mean, we had there's so many different data points that you can look at. Like PPI was yesterday, producer price index. You can look at PMI, manufacturer pricing and paid index. And I think the concern is that everything was coming in a lot hotter.
Right.
So I think at least my initial concern coming in today was that we were going to get at least 3.5.
Expectations
Maybe
were for
even.
3.4.
Well, it was funny because I was looking last week and expectations were 3.5.
Oh, so okay.
So I don't know if it was after PPI yesterday that the revisions came in and push it down. I don't know why you'd come down if PPI came in that significant, but who knows?
Yeah, you and I were looking at it yesterday. Wasn't it 3.4 for
Yeah, somewhere
headline
around
and
there.
3.6 for core?
Yeah, we were pretty much, I mean, it was an inline report, which I think was better than expected,
Yep,
right? I
that's
think
the
that's
bottom
the way
line,
I would
yeah.
look at it is because I always laugh to a certain extent is that, the difference between 3.5 and 3.6 is like a nightmare. Like, come on, really? Seriously? I mean, we were at 9.1 at one point on the headline stuff. So I don't consider that I think we're going in the right direction, right? I think we can all agree on that we're still that today's report didn't show a change of pace of going the wrong way. We may be stuck in neutral here for a little bit, but we're certainly not pumping the gas back on inflation. Would you agree with that?
Yeah, I think that's the exact takeaway from the market is that we're not going to reaccelerate inflation. So that means the Fed is not going to. The fear, I think, is ultimately that the Fed was retighten again, or raise rates, which I think that'd be bad for the overall market. Now I think it was kind of a sigh of relief saying. Now the other question we could ask is when will a cut come? I don't think that's coming anytime soon either. So if the market's reading in just an inline inflation print is going to be in a cut, I think that'll be misread as well.
Yeah.
No. I don't see why. Everything he has said that they want everything that they've from a commentary perspective has said basically they want to see the writing on the wall, and the writing's not on the wall yet that we're anywhere near normalized from a 2 to 2.5. We're nowhere near that.
When you hear a lot of discussion of how Powell does not want to have a repeat of history, right? The 1970s spike, come down and respike. I think he's been dreading that. And so I think they'll wait until they actually see it softening to do anything meaningful with the rate.
Yep. I think they would let it, unless they see economic trends deteriorating aggressively. Like that'll be their flag to say that they'll have to do something, and then they're going to go much faster than people anticipate probably at that point, right?
Yeah.
Until then, if we're resilient and we're creeping our way downward, they're not going to do anything. That's my personal opinion. I don't believe they're going to preempt anything. So if it's one later this year, sure, maybe is that. But I mean, worst case scenario for them is they cut one and then 3 months later they raise right back up and have to raise a couple times to do it again, right? Then they have no credibility and all that fun stuff that goes with that. So my side, I just don't see them doing anything until they have to.
Yeah, and I think the market's actually getting used to that. So I think they're coming to the realization that there's not going to be these massive cuts that's going to stimulate everything. So I think that's not a bad problem actually to have if we stay higher interest rates and long as unemployment doesn't tick, too much higher. Above
Housing
4%.
trends aren't collapsing.
No.
I mean, the activity level is, but buyers and sellers are finding each other now and that kind of thing. So people are getting, that's probably the epicenter of where you feel worst, right? In a higher interest rate as I'm buying a house.
Yeah.
Numbers nasty compared to what it was a year and a half ago, but compared to a year ago, it's not that different. People are saying, you know what? I still want to have kids. I still want to live in the suburbs. I think I'm going to probably bite the bullet on this rate, as long as it's okay. And I don't see it getting massively worse. And I can refi down the road, hopefully, if it gets lower.
Well, to that point, I think part of the issue or concern is that when you talk, at least when I was buying my house and I was talking to the mortgage broker, he was saying, oh, rates will come down eventually because the Fed will cut. And so I think at the beginning of the year, with the market pricing in 6 to 7, I guarantee you had mortgage brokers saying, well, rates are going to come down this year, so you can wait if you want. But obviously that's not the case. So I don't know if there's some people still just on the sideline waiting for that rate cut because their mortgage broker said rates were coming down.
Love it.
So I think that
the mortgage broker's got a pipe right into Powell. You know, Fed Chairman Powell. I talked to him yesterday. He's going to cut rates.
Hold off, guys.
I almost wonder if people are going to hold off still because they've been hearing about rates are going to come down eventually. So now I'm just going to wait until I can get a better rate.
How long can you wait?
Coming down, right? That's right.
Yeah,
it's interesting because if you need a move, how long do you want to sit there and watch these houses go on market and go off market? Because the housing market is still hot.
Yeah.
Like houses are still moving.
And a reasonably priced house still goes in days. It's not.
I mean, my parents just sold their house. It was listed for about 12 hours.
Yeah, exactly. So
it's a long time.
Exactly. Woo! Had to really wait. I had to wait overnight to get a bid on this thing. What is wrong with this? What is wrong with this market?
I think it was listed at 7 a.m. and
by 7 p.m. they signed the agreement.
Yeah.
Good for them.
Nice. Yeah, let's change gears here a little bit, Tyler and Jeremy. Let's talk about earnings season. We're now midway through May, and I think we've had a lot of companies report. Kind of what are your guys' overall thoughts on what we've seen so far, and kind of what that means for the overall market?
I think generally reports have been good. I mean, we talked about this a couple of weeks ago where we had about 50% of the companies report, and it was good then, and it's still been good now. I think what you're starting to see is kind of a bifurcation in consumer companies, though. So I think that's a little bit of a concern, right? You have some of the, Starbucks, McDonald's, like even McDonald's is you would consider a consumer staple, like lower priced items. But even there's
not anymore.
No,
well, on a $12 value meal.
$12 value meal, family of 4 is like $80. You're like, geez, what's going on here?
Is this a drive-through? Do I need a white napkin on my shirt?
Go to a sit-down restaurant and have the same price as McDonald's at this point.
Well, I've seen ads. Have you seen the ads for Chili's lately? They're talking about, hey, come sit down because the price is the same and that kind of thing. I mean, they're literally having that as a marketing ploy at this point now.
So you're starting to see that bifurcation, but then you still see companies like Louis Vuitton, one of the companies I own in the G40 portfolio. They had a pretty good quarter. Yes, overall volumes might be down, but they still have pricing power. So I think you're seeing, and that's a high end.
That's high end,
right? So I think it's more driven on the wage range. I think it's lower end wages are really starting to struggle, but your higher end wages are doing just fine. And you're kind of seeing that bifurcation in the companies that we look at.
Yeah, I would agree with that, with one caveat is that it's
always
also
a caveat.
There's also a the Jeremy caveat. It's an easy excuse for companies that aren't offering a lot of value outside of what we've always had, right? I mean, the consistent theme Starbucks quarter was awful, right?
Yeah,
just terrible, right? There's no question about it. It was bad. And a lot of it was, the consumer is stretched. Well, the feedback I heard from a lot of people was, why go there and pay $9 for the same thing I got before? Or you took this thing off the menu that I actually liked, and now I have nothing and I don't know what that. I think they have, and I own the stock. I think they have. I don't think we can just blame just what they did on just the lower end consumer. McDonald's, maybe it was a little softer, right? And the things, but I think also you have to have a value proposition, right? Is that Chipotle, their quarter was a blast off, right?
Yep.
They did phenomenally well. Costco, people are still spending aggressively at Costco. There's a value proposition in some of these companies that, and again, I like Starbucks and McDonald's over longer periods of time. I own the stocks, but the end of the day, you can't just blame the fact that consumers aren't spending, because they're spending somewhere. They're just not spending in your stores. And so there's part of that I think is actually happening. I think you're absolutely correct that part of that is the lower income consumers just hitting their wall and just saying $12 value meal. I'm just not going to do it. I'll cook at home tonight.
Yeah.
But the other side is you do have to offer them something that says, I want to come to your store for this particular reason. And some of the companies just aren't doing as well as that right now.
I mean, I will say we always get Starbucks, or
Yeah.
we used to, but now we're starting to
Lifestyles
sprint-
are rich and famous.
Yeah,
Yes.
right over there on
Yeah.
it.
But we've actually started switching to like a Dunkin', because it's like
Oh, I love Dunkies.
it's like $8 cheaper.
Is it
for the-
really that
for the
much?
same
Oh, and you
stuff.
get like a gallon too.
Yeah.
I mean, that
Nice.
large is like this big. It's huge.
I mean, my wife, even the medium, she's like, you got to stop getting me the mediums because I can't drink it.
Wow. There's
So
value.
I mean, there's, and that's I don't know if that's value add, but
yeah,
I
I think
mean,
they're
maybe that's
large
more
as
of a
an oil
trade.
barrel.
just a trade. Yeah, I mean, it's crazy. You get a lot of coffee. But yeah, it's interesting just to see the differences in the companies that are working versus not working. But I think overall, just general S&P 500 earnings have been the beats versus expectations has been above average.
Yeah. I
So-
read this the other day. It was like, I think we're beating this Q1 by 5.4% on EPS. That's a big beat. That's the biggest beat since Q2 of 2022.
Yeah.
So it's nice to see that acceleration. The other thing that we've talked about is the stock market generally follows, earnings. So it's nice to see these earnings growth. And if this is the best growth rate since a couple of years ago, that's great to see. The other thing is going into this year, the estimates for this year were, I think, about 11-12% right for EPS growth. And I think after this Q1 reporting, they're still at 11%.
Yeah.
So I think that's healthy. What
I
are
think
your
that's been
thoughts?
our biggest surprise, right? Is that we were talking earlier in the year and saying that number's probably too high.
Yeah.
We think it's a healthy market. We think it's healthy earnings growth, but we don't think it's probably 11%. Those numbers haven't come down yet.
Well, if you look at revisions for Q1 and Q2 estimates, right? So, 64 days out from the quarter is kind of your starting point. And then as you get closer to the actual report date, the expectations tend to come down, right? Companies start talking it down. Maybe maybe it's more of a target for the company or a high price target versus like actual expectations, or the target becomes the expectation coming into the quarter. And then people start saying, well, we're probably not going to hit the target, and it starts to come down. What's interesting is this quarter is revisions have actually gone up much more higher, like dramatically higher than normal.
Yeah.
So I think that's what's really keeping the full year estimate in line, is companies have just been better at reporting. And I think part of that maybe is cutting staff, right? We're starting to see a lot of layoffs here and there, not significant amounts, but companies are starting to really focus on margins rather than sales growth, I think.
Yeah, I agree. Now let's change gears here a little bit one more time. The big company we haven't seen report yet is NVIDIA, right? I think they report on May 22nd.
I thought you were going to say Walmart.
No. Yeah, Walmart's is coming up
Talking
here
about
too.
the consumer, Walmart.
Well, yeah.
Walmart's coming up. Target's coming
So
up.
obviously NVIDIA is the driver of AI. Tyler, do you want to speak? I was reading some stuff again on CapEx of what the AI guys are spending. It's absolutely mind-boggling.
It's monstrous,
So-
right? And that's when you start to go into the second and third derivatives of AI, if you will. You start getting into REITs, you start getting into utilities, right? That's the next stage of AI, if you will, on what these guys are spending. But before we talk about that, I actually have a question for you guys.
Uh-oh.
Because we're talking about CPI
Yeah.
and the Fed. Do you think NVIDIA is more important right now for the overall market than even a rate cut would be?
I actually do, to the extent of what their tone of what they, not just the quarter itself. I assume everybody thinks it's going to be a blowout like the last 3 quarters have been, but just from their standpoint of how important AI is to the overall economy right now, I think we're in the very early innings. So if they start throwing, say, things are really slowed down, I think that's kind of a big growth driver for the overall market right now in the next couple of years. So I think that could be a big dampener. How about you, Jeremy?
Yeah, the S&P 500. If we're talking about the S&P 500, absolutely. I think it's unequivocally more important, because if NVIDIA comes out and says we're starting to decelerate that spend, well, then Amazon, Microsoft, all these other names that have had a premium valuation as a result of that, they get hit. And guess what? The S&P 500, that's 25% of your index right there. So from the S&P 500's perspective, absolutely NVIDIA is more important than a rate cut. From the overall economy and growth and all the other fun stuff in the companies outside of the S&P, if you were equal weighting the S&P, it's probably less important. But on the S&P itself,
Yeah.
I think it's absolutely more important.
Yeah, it's just sentiment, right? Because that's
Yeah.
the new shiny object that's in every company. Even if you're not a tech company, you're talking about your AI. It's like even these fast food companies, right?
Yeah.
We have AI to drive through our Wendy's of saying, "Oh, do you want an extra cookie with your meal?" or whatever it is, right? I mean, it's crazy what AI can add to and where the dollar.
That's Keith Gangl.
That's my biggie
get a
bag.
cookie out of
Can I
it?
get a cookie out of this?
Oh my goodness.
How do I get a cookie out of AI? That's really there it is. There's the value prop
I
right
know
there.
where Keith's going for lunch.
Yeah.
But back to your point. So I mean, I think what the capex of
The four
Core
biggies, right?
is,
It's just
what,
talking,
170?
Yeah,
180
well,
billion?
Microsoft, Google, Amazon, Meta, I mean, they make up 39% of the overall tech capex. So those guys are driving it. But what surprised me is last year, I think their numbers were 2023 is $119 billion on capex. Just think about that. I mean, so that means all these companies that feed into
That's
that
McDonald's, right?
That's yeah.
From a market cap perspective.
All exactly. Yep.
Yeah.
Yeah. Actually,
Yeah.
probably
More
actually.
More than that.
about 100.
Yeah, so it's actually bigger. I mean, that's how much they're spending on just driving their overall information, their database of where all that stuff goes. And if you go back a couple of years ago, everybody complained about the big tech guys who were spending too much on capex, right? And so that's when the stocks actually got hit. And now I find it fascinating. They're re-accelerating it, so it's going to go from like 120 billion to 170 billion expectations for 2024. So that's a 50% increase. I mean, look at all those companies that are going to benefit from that. External capex.
Well, I think that's where you get down into the second and third derivatives of talking about REITs, right? There's certain companies, Equinix, Prologis, right, that would benefit from kind of the data.
Yep.
Because they have to warehouse, they have to store it, right? You also get into utilities and you've seen that, I think, lately. Utilities have been the best performing sector over the last, month and a half, 2 months, which is kind of interesting to think about.
Yeah, but we've also had interest rates go from 470 to 430 pretty fast.
Yeah, that
tends to be good for Utes too.
But just the amount of the energy that these companies are going to be drawing on for their data, for their models, for storage, for all of their AI-driven capabilities, it's going to be a lot of energy.
Yeah, I would agree with that. I'm also always pretty cautious on relaying those stories and saying there's going to be mass benefit.
Yeah.
Just from a perspective, the utility side, they still got to go to governments. They still got to go. I mean, it's a regulated entity, right? For the most part. So if production goes up and infrastructure goes up for there, it's good for them, but they still got a lot of ways to go. It's not like they can automate, they're not NVIDIA in that regard, right? In the effect of NVIDIA can say, we're the only chipset in the game. You're going to pay us what we want, and you're going to pay that.
Right.
Utilities have a lot of avenue to get to that level.
Well, it takes how many years to build out the
exactly right.
Them.
So
I think one of the other parts of utilities, though, is AI can play into utilities in how much energy do they actually need to buy, because they don't obviously generate all the electricity that they need to distribute. And so there's obviously peak times and drought times, if you will, middle of the night. So I think AI might actually help them be able to deliver the energy or the electricity that they need in a more efficient manner. And so I think that might also be a play for utilities, is to be more efficient in how they deliver their energy and not have to buy as much potentially.
Yeah, I mean, I think that's the big story across the landscape, right? Is how can we leverage this to make our business better?
Yeah.
Right. And that's why AI is considered such a big thesis right now, is because there isn't a company I can't think of that couldn't leverage it in some way, shape, or form to try to make their business more efficient. Right. I mean, and that's really what the pie in the sky is for AI, is utilities. How do we better price our demand? Consumer, how do we better get goods to certain areas? There's going to be a way, it's always harnessing data to try to do that. And AI is better at it than we are. Yeah. It's just that simple.
Yeah.
No, it's just amazing that, last week we talked about, going through chart books, but again, flipping through a blank slate. If you actually flipping through charts of the S&P 500, what looks like tech stocks with the big, parabolic rise is utilities, which absolutely I just find kind of funny. Is it usually you, Jeremy, you're a value guy, so you probably know a little better than probably Tyler and I, but historically, when do utilities work? I mean, is it
It's usually when we're worried about the market, right?
Yeah, right. And the markets are up 10%. So that's why I find it's a little weird, I think.
It's very weird. I think part of it's rates. Rates have come down, and so it's working through there. Also, they've been disasters for the better part of 2 years. So on a relative basis, this re-rally, if you will, is kind of, it's not even close to catch up, but it is catching up a little bit. But yeah, it is strange to see utilities and staples work when the market is up 10% plus on the year, because usually it's not even that those companies are going to outperform the market, or it's usually not on a positive outperformance. It's usually they're performing better in a bad market.
Yeah, they just don't go down as much.
They don't go down,
they're going up slightly, whatever your dividend yield is.
And so when the market's accelerating in all-time highs like it is right now, it's rare to see staples and utilities come along with that ride as aggressively. And I think that's part of it right now, is rates are coming down a little bit, and then there's just that catch-up play to a certain extent, is that their valuation relative to the markets are basically at 10-year lows. So even this catch-up here right now, it's not even an average on a valuation perspective. So I think from that side, that's what you're seeing is a little bit of a difference.
Yeah, one thing I was reading too is that they are, not only the AI play themselves, but there's so much power needed for these AI companies and the CapEx that's why they're going to expand. But your point is, that's a long tail for these guys.
Oh man,
it's so if they're playing it on that, I think that's
dangerous.
That's a little dangerous. But your other stuff makes sense to me. But if they're playing it for a true, bump on AI because they are the power supplier and they need more power for AI, I think that's a little bit of a fool's errand to play that game.
Yeah, I mean, I can give you a prime example. I just bought a utility, right? I bought Xcel Energy. I have no AI play in that at all. Zero. From my side, it was.
What? I thought that was the reason you bought it.
Yeah, exactly. I don't think. Yeah, I don't even think ChatGPT put AI in my thesis case on that one. So no, it from that side, from an investable point of view, there are a lot of reasons to own utilities. I think AI should be way down there.
Good. Glad to hear that. I'm glad you weren't just out there running around buying the AI team.
They're taking lines left and right now, or throwing them up in the air too.
What I thought is interesting, though, to your point on staples, why they're working, to the point earlier, I mean, 13% of staples is Costco. Yeah. And then you have Walmart, right?
Yep.
I think people are expecting that to be a pretty good quarter, because that's where consumers go to when they need groceries if they're going to be stretched. You've got Coca-Cola, which is doing okay, Pepsi, right? So I mean, there's still some good companies in staples that I think are keeping up.
Yeah, I mean, Procter and Gamble's, one of the better companies. We were just looking at Colgate today. We were like, is Colgate did they cure something that we weren't aware of? I mean, the stock
cured cancer
straight up. So there are definitely avenues that people are taking, but you got to remember, again, this is somewhat of a catch up in the effect of interest rates went up so fast that the valuations of these kind of companies, your staples and utilities, went way down, and compared to the market, they look super cheap. So even at this re-rally perspective, they still are relatively cheaper compared to their long-term histories. Yeah. So I think you're seeing some of that just rotational element, people maybe getting a little CapEx fatigue on the tech side and those kinds of things. But yeah, you're right. There are companies in there that are really good companies, right? At Costco and Walmart, at the end of the day, who knows about AI and all that stuff, but you're probably going to go spend $300 at Costco.
I know I do. All right, let's jump in here to your wait what segment here. I mean, another interesting thing is U.S. market capitalization. You guys know roughly what the U.S. capitalization of the overall U.S. stock market, not just the S&P 500, but the other companies as well.
It's more than $10.
It is more than $10.
Okay. It's like every company,
every stock, if you added them up, right? Apple's like 2.7 trillion, and if you add up all those,
I got no idea.
Well, it scales down pretty aggressively.
Yeah, after I'll tell you after Apple is cool. So, yeah,
so, I would guess maybe 5 trillion.
No, it's 51 trillion, right? Because you got Apple's 2.7 itself, right? So
Microsoft, Amazon.
Yeah, Tyler's math's a little rough this morning. So just
coffee there.
Yeah, wow.
Let's crank it up a notch.
Times by 10. Okay.
Yeah, okay. Times by I think you just had a decimal place in the wrong spot. So there it is.
See, that's why you go with my. It's more than $10.
Well, again,
you can't go wrong with that.
Can't go wrong
with that. More than $10.
We're talking about trillions of dollars. Does does it really matter?
Does it make sense to anyone? Absolutely not.
No.
Anyways.
So anyways, around 51 trillion. I think the S&P is around $46 trillion. So it's a lot, right? But the reason I'm bringing it up is I was reading an article again on buybacks, and it's crazy. You guys guess what the last few years buybacks in the next couple of years? I'll just tell you so we don't have to play this guessing game. But anyway, the expectations are for
you got Tyler sweating now over there.
We started. Tyler goes, this is last time Gangl's going to be on here with us, throwing us these math questions, numbers. But it's around so those alone are on $4.7 trillion, so about almost a little less than 10% of the overall.
That's crazy
market. So that's what surprised me. I'm like, wait, what?
I mean,
in buybacks, yeah, it's accelerated from 800 this last year, $800 billion of buybacks, right? And think about that. And reason I want to talk about is because of earnings, right? We think earnings are the overall driver of the stock market, but when you start thinking about the buybacks contributing to that as well, we have dividends, right? Which that's usually around 1.5-2%. But now when you're looking at this, it's around another 2% additive to the overall S&P growth. So it's like that's a big number. It surprises me, right? And you see it because you've seen other stats about less companies that are public than they used to be. I mean, I think it's down 40% from several years ago, just because there's a lot less companies coming public, and some go private, some get taken out. But that just shocked me. I'm like, wait, that much of a buyback is amazing.
Yeah, I would have never guessed 10%. Natural tailwind to earnings, right? At the end of the day, if you have less shares out there, you're gonna, your earnings per share are gonna go up as a result of that. So I think you're absolutely right. Is that, and I think companies have looked at it as, and this has been long, right? It's a capital market decision at the end of the day, right? Is I'm flush with cash. I can either buy companies, I can pay a dividend, or I can buy back my own stock, right? Those are your kind of three options, or I can plow it back into my own company too. So how do we do that? What's the best way of doing it? I think companies have leaned more towards buybacks a lot. I think that's been a secular change, and I think that's going to kind of continue because of the flexibility it offers, right? Is that a dividend? People expect that you are locked in and you're paying that going forward, and you better be growing it too, because if you stabilize the dividend, people are, what's wrong with your company, right? Whereas if you do $1 billion in buyback in 1 year and then 500 million the next year, people look at it for about a second. But then for the most part, they're like, oh, okay. As long as the share count is coming down. Yeah, sure. Thanks for doing that.
Yeah.
It just offers them more flexibility to do things. So I think buybacks, I'm, like I said, very surprised at 10%. I didn't think it would be that big.
No, it's big. And look at what they announced. Tyler, was 110
billion.
So I guess you start putting a few, again, Apple's the biggest of the big, right?
But
I mean, 110 billion. So I guess you start adding 110 billion here and 5 billion there. I guess you can get up to that, $1 trillion. But
the big
amazing.
tech companies too are just awash in cash, right? And so what do they do with all that cash? They're not just going to let it sit there. So they can either go buy companies, which that has its own risk.
I mean, almost, right? Just because the fact.
Who are they going to buy at this point, and how much is the government going to let them?
That's what I mean. Regulation-wise.
So you got two fronts there. So they're just like, well, what do we do with this? So I guess, we've got a boatload of cash. We've already done our CapEx budgets for the year. We're going to do that going forward. We've already got our OpEx set up. We got a bunch more cash. Might as well just buy them back. So as you see, again, as tech companies get bigger and bigger and bigger, and these companies are generally very, very healthy cash generators, you might see that continue to go up.
Yeah.
Which is crazy to me. I always get a little concerned when we talk about buybacks accelerating in an all-time high market. It's like, if you're buying your own company stock and you're saying you're opportunistic. Yeah, exactly. Are you really buying that low? But hey, if you got the cash and you don't have anything else to do with it, might as well buy back some stock.
Yeah, I think part of it you mentioned is those big mega cap names. They're generating so much cash that they can only invest in so much, right? Obviously, we talked earlier in this segment about increasing their AI budgets, right? The CapEx. So that's where part of it's going.
Yeah.
But other than that, it's like there's not a whole lot that they can do. I mean, some of them, now we've seen some of the mega guys actually initiate a dividend as well recently.
Yeah.
So a couple of big guys have done that. So that's part of where the cash flow is going. So,
yeah, honestly, I
feel like that also tells you that they either don't know what to do, right?
Yeah.
Like, what else do we do with this cash?
Yeah.
Or they're worried about regulation, or both.
Well, they know they can't buy
because they can't buy anything.
They know they can't buy.
They know they
can't buy significant.
Yeah, exactly.
They're already under scrutiny.
There's no chance,
especially of size, right? Like maybe they could go do some small transaction, but they can't do something that's going to take even more market share.
I think that's another reason why you've seen the dearth of public companies too, is that, you know, they're getting bought out before they ever even can get public, because the companies that are growing, these technology companies, have so much cash. They're just like, yep, that's I'm going to take that shot underneath my flag rather than let you steal my business down the road when you IPO.
Yeah. Before you're of size.
Exactly.
Before,
I'm going to take the
Yeah.
shot. Yeah. I'll cut you a big check. Now it's going to be a life changer to you as a business, on the 1 in maybe 100 shot that this becomes the next, and probably worse than that, but on the shot that this thing becomes the next thing that could take my business away, I'm just going to buy you out.
Right.
I think there's more and more of that, because the companies have so much cash, and they can't buy each other. Right. There's no way.
Well, and regulators aren't looking at it either, because it's like, you just paid this company $100 million.
Yeah.
It's meaningless.
Months worth of cash.
They don't have any market share. So sure, go ahead. And then they can potentially grow it into something that does take market share.
Yep.
Yeah, cash is king, I guess. And so that's one thing that makes me feel better about the overall market, that there is that much cash getting generated and they're buying back stock. That
you and I look at this a lot, though, is that, are they buying back stock? Are they levering up to buy back stock? That's more of a worry in my world than probably yours. But I do look at that a lot, is, hey, are you ratcheting up the leverage just to buy back your own stock? That's a problem for me. Like, I don't like that from a trend from a company. If you're using internal cash, you're just generating it and you can pay a dividend and buy back stock, sure. But if I see your debt, your debt ratio start going up to get that,
so you're paying more attention to free cash flow, ex dividend, post dividends, and post buybacks.
Yeah, I don't want
if they have any cash.
Yeah, I don't want your debt measure. Your debt to EBITDA. Not to get too nerdy here, but
nerding out session.
Nerding out session. But I don't want that number going up at the same time you're telling me you're going to buy back a bunch of stock. Right? Why? Stop levering up to buy that, unless it's a massive opportunity, and you better really explain that to me. But from my side, if they're keeping debt metrics pretty consistent, or even bringing that down while still doing it, I'm fine with it.
Yeah, especially with rates, going up as well. I think that'd be a pretty poor decision if
it's terrible.
If you're taking up debt levels.
I just don't know why you would do it at this point.
That makes sense.
Stock down 30%, opportunistic.
Yeah, I guess levering. But you're just levering up to buy. Do we tell our clients lever up to buy the stock market?
No, that's usually not the advice we give.
Not the advice we would go with.
All right, let's get to some fun stuff here. We've all, myself, Jeremy, Tyler have all been, we're in a house now. And the thing now, people have done is building decks. And actually, Tyler's in the
Minnesotan tradition.
The Minnesota tradition, right? I mean, the weather's nice in spring here now. And Tyler, what project do you have going on right now?
Well, I just finished my deck. Thankfully.
Wow, how'd that go for you?
I'm not done yet. I was telling you earlier that I kind of have to redo my stairs because part of it's sinking. So I might have to do some cement.
Yeah.
Unfortunately.
Did you build it in quicksand?
Well, no, because I was trying to do my steps, and to make them level, I dug out some of the ground, right? And then I had to pack more in, and I probably didn't pack it in tight enough. And so now it's kind of...
See, every word he said after I had to went right over my head, because these two both know that I do literally nothing on my own.
So to back this up a little bit, right? So I've been in my house for 25 years and had a deck that was 20 years old, a few years ago, and I remodeled and went from that wood to the composite. That's part of the reason I own AZEK stock as well. Not just for that reason. But the trend.
I saw the price.
I saw the price. I couldn't afford it. Like, geez. No, just a trend of people going from wood to composite, and how much better and how longer it lasts. I think that's a huge mega trend for us. That's how we theme investing. We talked about last time that plays into that as well. But so I've done that, and it in college and stuff like that, I've come from building houses and decks and stuff like that. So, it was a pretty big project, and it looks good. And Tyler's asking for a few tips on some of the stuff, because I've built my own house. And a few things. Because
yours, you had to be on a ladder the whole time.
Yes,
whereas
mine's 2 stories.
My first level just basically walks out. So my deck is only like 3 feet off the ground, so it made it a little bit easier. I don't know how to do that. That's beyond my pay grade.
So anyway, I've gone through this experience a few years ago. And Tyler had a few questions for me, so I was passing on advice. Now, Jeremy, on the other hand, has been, he's been looking at houses and decks for the last several years. So I always get a kick out of it. And he's been the last couple of years, he's been looking at remodeling his backyarding and adding a deck, but he's had a few issues. And Jeremy, you want to walk kind of what Tyler's did, do it yourselfer, so he's kind of working through this thing. But you're obviously you're not quite the do it yourself.
No, I got Bob Vila and Tim the Toolman Taylor over here.
Do you own a hammer?
I do
Oh,
know
okay.
how to do some things, but the thought of even grabbing a piece of wood or AZEK or whatever to start building a deck, just like, no, it's an absolute no. It's not. It never even entered the thought of my mind about I could do this myself. No chance, no way, no how. And I would be divorced in a week and a half. When my thing started sinking, because mine would be at like 45 degrees, it would be a problem.
I mean, my stairs aren't sinking. It's like
He's only got 2 steps only, fortunately.
It's like half-inch sink. It's not that bad.
Tyler celebrated Sinkhole de Mayo.
Yeah. Cinco de Mayo.
But yeah, I have a different set of problems than you all, right? Yeah, I listen to these two and I laugh about, smashing fingers and doing all this stuff and this didn't fit right and my stairs are sinking.
Yeah.
I laugh about them when they do that, but then I've got to go try to find a person to actually build mine, and that is just an absolute nightmare. Oh, it's no fun at all. I hate every single second of it. Getting bids, trying to chase people down for bids, trying to get the timing right and set up for their time and all of that stuff. It is absolutely horrendous. I feel like it's the Stone Ages and I'm like bartering for tools.
The amount of time
things
that you've spent trying to get a bid, I bet you could have built your deck.
I do know. I would take the other side of that argument any day. You just asked me if I owned a hammer.
Yeah, that's
and
true.
you think I do not own any particular type of power saw or anything like that because I would have less digits. So from my side, no, it still does with the pain I've been feeling of trying to get this done. It nowhere near matches my willingness to do anything like that. It's just never going to happen.
No, I mean,
but you had a patio, right?
Yeah. Did I do any of that work?
No. I know.
he just wrote the check.
Yeah,
Well, I
exactly
know
right.
that.
Yeah.
But did you get it same like when you were bidding that out?
Inside job there, Tyler. I had an uncle who was in the game on that one. So the patio got done that way. So that got done easily. And then there's going to be more of that coming down the road. But anything external.
You didn't go back to him for the deck?
Oh, not for he doesn't build decks. He builds patios. He does concrete. He doesn't do.
But wouldn't he be a contractor or like outdoor landscape?
He's specializing. Not like you. You're a well-rounded
right, exactly.
guy.
Da Vinci over there wants everybody to do everything.
There's only so much time a guy can watch YouTube videos, Tyler. Everybody's
got a lot of YouTube University on that one.
Now, speak to you talk about getting bids and, last year you're getting bids and this year you're getting bids. You think it's getting a little easier? Is there more people available? The reason I'm asking is just kind of, I always like to ask people whatever they do, kind of judge the overall health of the economy. Now, your situation, you've been doing it for a while. Do you think it's getting better, easier, or is it still tight in that?
Timelines are better.
Okay.
So the people that are actually coming out to bid are ready to work, if you will, which again is probably not a great sign, to be completely honest with you. It's that they're easier to launch, if you will. Like 2 years ago when I started some other stuff, they'd be talking months, right? And you're out. Now it's weeks. And now it's like, hey, if we lock this in, I can probably start in 3-4 weeks. 2 years ago, that was 3-4 months, right? And the materials were crazy. They had to source a bunch of stuff. I don't hear that stuff anymore. But the prices have not come down one iota.
Yeah, you think especially with a deck, that's a lot of labor. I would just rule of thumb is probably half labor, half materials.
More like 70-30.
Yeah, so you would think that with things were slowing a little bit, that at least your labor would start tipping a little bit. I know. Yeah,
nobody's at least trying to discount yet. Nobody's using price as a lever.
Oh, okay.
Let's put it that way. Nobody's using price as a lever. They're using time and value, if you will, as a somewhat of a lever, but they're not using price. They're not saying, we can give you 10% discount if you get, on the docket in the next 3 weeks. Nobody's doing that.
Well, based on the bid that I got for my deck, because we were going to just have someone build it, because I didn't know if I would have time to actually build it with 2 little kids. But it was about based on what we spent for our materials.
Yep.
Granted, I've made some mistakes. I had to buy some more, but
the rookies. But you learn from that, Tyler.
Yeah, I learned.
Your next
but
deck will be
it was about 50% labor, 50% based on the bid that we got, 50% materials.
Yeah, that seems reasonably. Not reasonable, but at least kind of what the going rate is.
Yeah.
So I guess if you don't find anybody, Tyler looks like after he gets his sinkhole finished, he might be able to come over to your place and start
Well, mine is elevated too. So Tyler sounds like
I'm
he's
out.
anti-ladder.
He's anti-ladder.
I had to. We put a pergola on our deck, so I had to build that on the ladder, and we use cedar boards, which are not very heavy. But I can't imagine being on a ladder by myself trying to hoist up a green treated.
Yeah,
board. That sounds.
I'm out.
Awful.
I had in one part of my deck, it was a walkout ramble or whatever, but then it dropped off part of the yard that I added onto. It was about a 20-footer, 6x6 post holding them up there by myself. Some kind of kids in the house, the wife's like, "Oh, hey, just don't hurt yourself."
Yeah, you're describing my nightmare.
Yeah.
Gangl, that is literally like a fever dream I would have.
That's not happening.
So anyway, you learn a little bit of stuff from that.
I did learn a lot.
Yes.
I could build a deck again.
Yeah. So anyway, Jeremy, we hope you at some point in time get this project finished, or your girls will be graduating from high school and
Pretty
college,
much.
maybe.
Yeah, they'll be done. They'll be done and over with, and I'll still be bidding it out.
But at least you got your cement work done. So I mean, as long as you got the inside, your uncle should be able to. Nothing else. Maybe you should cement your whole backyard, and who cares about the deck?
Sounds like a plan.
All right. Well, that was episode 5. Keith, are we gonna have you back for?
I don't know. After
4 times in a row,
we'll have to see what the numbers come out and shake out after me somewhat hosting this thing. You may not see me for a while, guys. So it's nice talking to the audience.
Keith will go on a hiatus.
Yeah.
Doesn't want to come back. All right. Well, with that, hopefully we'll see you next time.
Sounds good. Thanks.
We probably talked right over.